Welcome, everyone. I'm so excited to kick off our top stocks for the second half of 2025 event. We're thrilled to continue the conversation from our investing forum that we had earlier in January with fresh insights and actionable ideas for the second half of the year. My name is Emma Johnston, and I'm a quantitative strategist here at Seeking Alpha. Today, we have the privilege of hearing from Dr. David Kelly, Chief Global Strategist and Head of Global Market Insights at J.P. Morgan Asset Management. Many of you probably know him from his insightful posts on LinkedIn and the JP Morgan website, and now he's here to share his latest macro perspectives with us. Following Dr. Kelly's remarks, we'll dive into how to turn those big picture insights into real investment opportunities with our own VP of Quant Strategy, Steven Cress. I hope you guys are ready for a jam-packed session today. Before we kickstart our conversation, please bear with me as I get through some housekeeping and get this disclaimer out of the way. Past performance is no guarantee of future results. Any views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared during the event cannot be guaranteed. Content is offered for information purposes only. All event participants must comply with Seeking Alpha's events policy. Analysts, investing group leaders, and other third parties participating in the event include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Whew, okay, that's out of the way. Now, without further ado, let's get started. I would like to invite our guest at the top of the hour, David Kelly, to join me so we can dive into what's been happening in the market, what's been happening in 2025, and where we can expect to go from here. So, Dr. Kelly, thank you so much for being here today. I think it goes without saying that 2025 has already been a remarkably eventful year with significant shifts in government policy, the economic landscape, and market dynamics. Taking us back to the beginning of the year, what was your perspective on that at the start of the year?
Well, first of all, thank you, Emma, very much for having me on your program. Uh, so I think that's a good place to start. I mean, when we went into this year, I think that we were in what I would call a post-cycle economy. We'd been through the pandemic recession and then the huge bounce back from that. We'd seen higher inflation, strong economic growth. The Federal Reserve reacted to that. Inflation had come down, but the economy didn't go into recession. It just sort of slowed down, and we were growing pretty steadily. I remember our forecast for 2024 was 2024. That's 2% real growth, zero recessions, inflation coming down to 2%, unemployment sticking at 4. And honestly, going into this year, my first instinct would have been simply to take last year's forecast and just use it again because it looked like 2024 for 2025. It was a very stable economy. It wasn't booming, but it's very hard to sink the US economy. And if you've got some growth in productivity, some growth in employment every year, and inflation stayed pretty stable, then we could have kept going at a slow pace for a long time before we had to adapt to, and we're still adapting to, the policies of the new administration.
So you mentioned some of those policies. I think tariffs really appear to have triggered the most pronounced reaction in markets,
Yeah.
and I'm curious where you think we stand with those tariffs.
So I think the policies, particularly tariffs, I think immigration, I think the budget, they've all had an impact. But we have many of your viewers, I hope, know this, but we produce something called the Guide to the Markets, and all these charts are in our Guide to the Markets, which we update by 10 a.m. U.S. Eastern time every day. And this is from one of the pages, and it shows what the tariff rate is. And what's interesting is we go back to the year 1900 here. And if we had stuck with the tariff rate as it was back in on April 8th, the tariff that we were imposing upon markets around the world, it would have been higher than any rate we'd seen since the year 1900, higher than the Smoot-Hawley tariffs, higher than the tariffs at the turn of the last century. But as it happened, then we sort of de-escalated with China, and then we put a pause on with 10% tariffs on everybody else. Now we're still working through that, but I think the end game is going to be much closer to the blue line of that chart than the orange line. I think we're going to stick at somewhere between 10 and 15% tariffs overall. I'm not I obviously try and talk about policies, not politics, but I'll be open about the fact that I'm not a fan of tariffs. I think that tariffs increase inflation and slow economic growth, among many other bad things they do. And so I do think we'll get higher inflation this year because of that. I think the inflation rate could be up at 3.5% on a CPI basis by the end of the year. I think growth is being slowed down right now, real time, by the uncertainty that tariffs have caused. But for the, if we see some more stabilization in tariffs, even at these levels, I do think the effects of tariffs in the economy will gradually diminish. I think the economy will adjust to these levels of tariffs.
Thank you for that. So you mentioned immigration in that little vignette there. Could you speak a little bit to how recent shifts in immigration policy might be influencing your outlook today?
Yes, and obviously it's a very political and controversial subject, and nobody can defend the huge surge in unauthorized immigration that we saw in recent years, which is largely a reflection of U.S. law, and U.S. law still is that if you are on U.S. soil, you're entitled to a free hearing or a fair hearing of your claim for asylum. The problem is that was being abused by many people coming across the border, and so you ended up with this huge surge in immigration. When the new administration took office, they slammed the doors on that. They sent 10,000 US troops down to the southern border. The Mexicans did the same on their side. But more than that, the messaging from the administration has been so aggressive on deportations that it has sent a very clear message to the world and to those who might immigrate to the United States that do not come here without authorization. And so it's collapsed. And so what we're seeing, in addition to that, we've seen significant deportations. The deportations actually aren't any higher than they were a year ago because a lot of these are from northern cities as opposed to from a few miles across the border because there are fewer people coming in unauthorized. But still, you've got significant deportations. And we're also seeing a decline for various reasons now in the number of people who are applying for, or at least being granted, immigrant visas in foreign embassies. So people don't want to come to immigrate to the United States in the traditional way as much as they did. You put it all together, it may be that net immigration into the United States falls to maybe 200,000 or 300,000 per year. That's actually significant because if you go back, since the start of the century, the US has seen about 1 million net immigrants per year come in. And if you take that down to 200 or 300,000, actually what that means is the working age population is going to be shrinking over the next 5 years by about 500,000 people per year. And the reason I bring this up is because we know the baby boom's retiring. They're entering their mid 60s and actually entering the 70s now. But as the baby boom generation retires, the population age 18 to 64 is shrinking. And so you need immigration to grow the labor force. In fact, what we show in this chart here, I don't know if you can see in the top right there, we show the growth in employment, how much of it's coming from people who are born in the United States, which is in the dark gray, but how much is coming from people who are not born in the United States, which is the light blue in those bars. And half the employment growth we've seen so far this in the last few years has come from people who are not born in the United States. So if you have a sudden sharp reversal in immigration, we can run out of immigrants, run out of workers. And I think that's beginning to happen here. And so how this feeds in is, if you look at the left-hand side, we show payroll employment. And payroll employment growth has slowed down too. It's running about 125,000 per month. I think it'll slow further. I think we'll end up running about 75,000 per month. But even at 75,000 per month, which is just a pale shadow of what it had been, if there isn't any immigration, then that may not push up the unemployment rate. So we may still be in a low unemployment rate economy. Maybe the unemployment rate stays at 4.5% or below. A low unemployment rate economy with still very slow growth, if any growth in employment. I think that's the impact of this very sudden reversal and very sharp reversal on immigration policies.
And I guess to that end, maybe you could speak a little bit about DOGE cuts and the so-called Big Beautiful Bill Act and how that might be impacting labor market participation.
Yeah, so as we went into this year, we had these Doge cuts also onto the new administration. Actually, we showed in the next chart here, we showed the overall federal budget. And if you look at the federal budget, we saw, and actually I think if we move to the next page there, you can see that. But if you look at the federal budget, this year it looks like we're going to run a deficit of about $1.865 trillion. Now, the Doge cuts to federal employment are going to make a small, but I'd emphasize a small dent on that. There are about 23 million workers, civilian workers in government in the United States, 23 million. But of those 23 million, 20 million work in state and local government. Only 3 million work for the federal government. This is overwhelmingly a state and local government system. And so those 3 million, we do think that that is clearly falling now. We think it's going to go from 3 million at the start of the year to 2.7 million by the end of the year. So down 300,000. But with a typical payroll job growth of about 150,000 in this economy, it's only worth about 2 months worth of job growth. Of course, it's traumatic for those employees who got laid off, as is always the case with layoffs. But it doesn't have a huge impact on the budget. We think it could save about $30 billion on a running rate from the federal budget. But as I said, the budget deficit's 1,865, so maybe the budget deficit's 1,835, but it doesn't have a big impact. But still, it's having a dragging effect in the economy. We can see a lot of this. You can see that in the retail sales numbers we saw this morning, where a lot of parts of the economy are pretty soggy. But that's what brings me to the what the president calls his one big beautiful bill. Um, this bill does not cut, there's a big focus on cuts in government spending, but it doesn't cut the deficit in the long run. And actually, if you pull back to that last chart here, I just want to talk a little bit more about that. So on, so what I think what it's going to do is it's going to increase the deficits going on out from what they would have been because we're extending all the Tax Cut and Jobs Act tax cuts. And even with some tariff revenue, even with some cutbacks, it's going to leave us with more with bigger budget deficits, but particularly in the early years, because what we're doing here is there are some special tax cuts apart from extending the Tax Cut and Jobs Act tax cuts. There is an increase in the standard deduction. There's an increase in the child tax credit. We're getting rid of taxes on overtime, on tips. There's a special $4,000 benefit for seniors. These things are all kicking in, but they're kicking in from January 1, 2025 to December 31st, 2028. So for 4 years. It's a 10-year budget, but it's for 4 years. And so we're using 10 years of spending cuts to pay for 4 years of tax cuts. And of course, when it comes to it, they'll probably extend those tax cuts. But for the moment, that's how they fund it. But also because it's kicking in at the start of this year, not the start of next year, start of this year, what it means is there are going to be big income tax refunds because for most of this year people aren't going to get the benefit of these lower standard deductions or child tax credits. But when we get into next year, they're going to discover, hey, I owed a lot less taxes in 2025 than the government took out. Therefore, I'm entitled to a big refund. And so you get this big surge of refunds going into the economy, which should goose up the economy in 2026 and lead to a stronger economy in 2026, even if we, at least in the first half of 2026, even if the economy slows down for most of the rest of this year.
Interesting. So I guess given all of that, what is your outlook for economic growth in the coming years?
Yeah, I feel like a weatherman with sort of a 10-day outlook in front of him. So it's going to get colder and damper, and then it's going to get warmer, and then it's going to get damper again. So let me try and explain. So initially, we've got this drag from Doge cuts and the tariffs and the immigration restrictions. That's all slowing the economy down. Well, the first quarter was negative in GDP terms. I think the second quarter will be positive. If you look beneath the surface, what's going on is what I call real, or what they call real domestic final sales. So you take the imports out, you take tariffs out, or imports and inventories out. You just look at what's being sold that's being produced in this country. That grew by 2% annualized in the first quarter. We think that it's growing by essentially 0.2% in the second quarter. We think it's going to shrink in the third quarter. That tells me the economy is slowing. When that fiscal stimulus kicks in, though, maybe in withholding schedules in the fourth quarter, maybe with bigger income tax refunds early next year, the economy heats up again. But then in the second half of the year of 2026, it's going to cool again because those refunds have got spent, and so it's going to cool down again. So I think ultimately this is a 1.5% economy. This is an economy capable of growing about 1.5% if we don't have any real labor force growth. But I think it's going to come in a wave here. So ultimately, by the end of next year, it's going to look pretty soggy again, and possibly, push inflation down.
And what about unemployment? Any thoughts there?
Yeah, I mean, if you look at the next chart here, we show the unemployment rate right now. It's at 4.2%. I think it might edge up to about 4.5%. But remember, you have to have because we've got these deportations and very little growth in the overall working age population. In fact, declines in the working age population. That prevents the unemployment rate from going up. You just don't have enough people available to push the unemployment rate up. So I think the unemployment rate could go up to about 4.5% by the end of this year, but I don't expect it to do much more than that. And I think it's sort of stabilized going into next year and maybe come down a bit and then maybe go up a bit in the second half of next year.
And lastly, inflation. What are your thoughts there?
Well, the inflation numbers look pretty good. If you look at the next chart here, I love this next chart here because it really shows what happened with inflation. We put a lot of thought into our guide to the markets charts, and this one is I'm particularly happy with. It shows how inflation was 2% all the way into the pandemic. And then as the pandemic hit and you had the policy response on Ukraine, inflation bounces all the way up to 9.1%. It's energy, it's core goods, it's services, it's shelter, all those things. And now you can see the inflation rate came all the way down to 2.3% in April, and now it's 2.4% in May. Unfortunately, I think it's going to keep on going up. So I think that by the end of this year, you're looking at CPI inflation of about 3.5 to 4%, mostly because of higher tariffs. And that means the consumption deflator, which is the one the Federal Reserve looks at more, that's going to be up at about 2% on the inflation rate sorry, it'll be up at about 3% or a little over by the end of the year. And then again, that inflation rate I think will cool down in the second half of next year back down to 2%.
Great. Okay. On to our next question. I think it's a topic that's very timely given the events of last Friday, but maybe you could speak a little bit about the ongoing conflict in the Middle East and how it's impacted your outlook.
Yes, it's very complicated, and I'm not going to go into all the details here because just yeah, and it's changing a lot. But I think we've got sort of a bimodal outcome. The most likely outcome right now is that you have this conflict between Iran and Israel resulting in the destruction of Iran's nuclear capability. But no matter how angry both sides are, I think it most likely will kind of stop there. But it could escalate easily. So I think the next big question is, will the US use bunker busting bombs and the US get involved directly in trying to destroy the underground nuclear facilities run by Iran? And that's the kind of military force you need to get rid of them. But unfortunately, it does pull the US into the war. But I think even then that it might sort of stop at that point. The danger is if Iran attacks civilian targets or other targets, and as a result, Israel retaliates by taking out Iranian export capabilities for oil, maybe by blowing up their export facilities in Karg Island, then Iran doesn't have the ability to make money out of oil. And if it doesn't have the ability to make money out of oil, then it may try to stop other countries from shipping oil through the Persian Gulf. And so it could end up in a pretty ugly situation for the global economy. I'd say that's a long shot. It's more likely that you end up with pretty stable oil prices, maybe up $5 or $10 from where they were before this action. But that's a risk there. And the reason you diversify is not because of what you expect to happen, it's because of the stuff that you don't expect to happen.
Sure. In terms of other timely topics, let's talk about the Fed. They have a meeting this week.
Mhm.
Do you expect them to cut interest rates, if at all?
Well, no, I don't expect them, and nobody else expects them to cut interest rates this week. This year, though, my expectation is they'll only cut interest rates one time. Now, I think they may actually forecast two rate cuts when they meet this week. That's a very, very close call. But my logic is as follows. At the last press conference that Jay Powell held, the Fed chairman, he said that, they've got two goals. They've got full employment and getting inflation down to 2%. And if those two goals are in tension, in other words, there's a tension between them. They're missing on both goals. They will look how far away are they from their goals, and how long will it take to get there. Now, on unemployment, as we are just talking about, in the long run, the Federal Reserve thinks the unemployment rate should be about 4.2%. And as I said, because of immigration, I think it might only get up to 4.5% by the end of this year. So off by about 0.3%. But the inflation rate, the long run, they want it to be 2%. By the end of this year, you could be up at 3%.
Hmm.
And so, for the Fed's perspective, well, why are we cutting at all? And what's more, they'll look at that and they'll also say, okay, maybe we have more certainty about tariffs. We still don't know how much fiscal stimulus is going to push up inflation in 2026. So I think that looking at all of this, they may cut interest rates by a quarter point in December, just as a holiday present to the markets or to the administration. And then I think they'll also wait until well into 2026 for another rate cut if the economy seems to be fading later in 2026, maybe you get some more rate cuts, a few rate cuts combined at that stage. But I think they're going to take their time because both the tariff policy and the fiscal stimulus are likely to be adding to inflation, as will the immigration policies. And I don't think the Federal Reserve wants to be seen as enabling a higher inflation rate if they already think inflation is too high.
Interesting. And maybe you could share your thoughts about the dollar. It's been in the headlines recently, the sell America trend. What are your thoughts on the dollar in the coming year?
Yeah, I think that's unfortunately phrased. I mean, I think that, I mean, the dollar is too high, but the dollar is not our national flag. You know, our national flag is the stars and stripes, and you should fly it as high as you can. But the dollar is an instrument of, of monetary or financial engineering. You should set it at the appropriate level for the country. And the problem is it's been too high for too long, and that has meant that our stuff is expensive. And as you can see on the right, we've run a huge current account trade deficit. And what that really means is there are a lot of manufacturing jobs and other jobs in the United States that have been lost over the years because of a high dollar. And so it's appropriate that it comes down. And but I think I'd rather call instead of sort of sell America, I'd rather say invest in the world because people are not invested in non-US equities in big numbers, but they really should be. The US equities are have a forward PE ratio or valuation which is about 50% higher than stocks outside the United States. So it makes sense to diversify a portfolio. I think people have been doing that. I think that's helped bring the dollar down, but it's only brought the dollar down a bit, as you can see in the chart on the left. And so I think the dollar will come down some more in the years to come, and that should amplify the return on international investments for US based investors.
And I guess in terms of corporate profits, what are your thoughts there?
Well, if you move to the next page, we have a chart on profits, and a lot of people focus on the left-hand side. How are the profits doing relative to analysts' expectations? And so this year, the analysts looking for 9%, and maybe we make that. I think we might come in a little short. The following 2 years, double digits. I don't really think we're going to do that. But if you look at the right-hand side, it really says something remarkable about American corporations. Those are profit margins, earnings divided by sales for the S&P 500. And you can see the great financial crisis and you can see the pandemic, but look at the trend. I mean, American companies are extraordinarily good at squeezing their suppliers, squeezing their customers, and scooping up all the benefits of productivity for themselves. They're still capable of doing that. And I think this is a soggy economy. I don't think it's going to be a recessionary economy necessarily, but it's going to be more, I'd call it an Irish summer of an economy, basically, just mostly rain and kind of damp. But I don't know if you've ever been to Ireland in the summer, but everything grows in Ireland in the summer. Everything, all the hedgerows are overgrown, and it's because it's actually a good growing climate. This is not a bad climate for profits. So I think profits will still grow as businesses take advantage of the fact that workers really don't want to pay, don't feel brave enough to ask for a pay increase, and they take advantage of productivity gains from AI or anywhere else. So I still feel pretty good about profits. I don't think double digit in the next few years, but I think they will rise.
Great. So let's try to tie this all out. How should investors be thinking across different asset classes? And I think we should start with bonds.
And so if we move to the next page, this is a lovely chart that we use to make the most basic point about bonds. We go back over the decades and we ask the question of, well, what's the relationship between the yield today and the average annual return over the next 5 years? And I can't remember from my geometry exactly what Euclid's definition of a straight line is, but this must be pretty close because it's an extraordinarily tight relationship. If the Bloomberg Ag is paying about 5% right now, you're going to make about 5% over the next 5 years. So I think bond yields are about right, and I'd be pretty neutral on bonds. I wouldn't be taking a lot of credit risk. I wouldn't be taking a lot of duration risk. So I wouldn't be buying a lot of long-term bonds. But feel perfectly if it's a 60-40 portfolio, I'm not going to worry about the 40%. I want it in a broadly diversified fixed income portfolio.
And what about US stocks?
Well, if you move to the next page, that's a different story because there's still this extraordinary imbalance and concentration. And if you look at the chart on the top right, you can see that about 37% of the value of the S&P 500, so well over a third of the S&P 500, is just in 10 stocks. And they fell off a lot at the start of this year, and then they bounced back a bit, but it's still very, very concentrated. And if you look at the valuations which we show over on the left, it's clear that the top 10 stocks are much more expensive relative to their history than is the case for all the other stocks, which is in blue. So I don't have a problem with investing in the other stocks, the blue, but I do have a little bit of a problem with the green. So I think you have to be active, and I would sort of, to me, the most important thing about being active in large cap US equities is to try to be underweight the mega cap and overweight the just large but not quite mega cap.
And another theme I think that's been getting a lot of headlines this year, maybe you could speak a little bit about international stocks.
Yeah, if you turn to the next page, you can see we've got a lot of charts in our guide to looking at international stocks, but the one I wanted to emphasize is, and I hope you can see this here. If you look at the second column down in this chart on the left-hand side, on a year-to-date basis, and this is through June 13th because we update this thing every day, every business day. But through June 13th, if you were invested in the S&P 500, you were up 2.2% in US dollar terms. If you invested in Eurozone stocks, you were up 26% or 25.9%. So this has been a very good year for international equities. But I would still say, if you look at the right-hand side, 64% of the global stock market is still in the United States. I mean, the US doesn't account for 64% of anything else in the world that I can think of that's important, but it's 64% of the global stock market. And I think a lot of investors have more than 64% of their overall equity exposure in the United States. So I think it's time to diversify. This is not a sell America trade. It's just recognizing that US stocks carry a 50% higher PE ratio than the rest of the world. You have to pay 50% more for a dollar of US earnings than you would pay for a dollar of international earnings on the average international equity. That's too high. And so I think this is a time to diversify and add, for the vast majority of investors, add something to international portfolios. Particularly, I think, Eurozone equities make sense. Perhaps some LATAM equities make sense. Maybe Japanese equities, but I think you can sort of spread it around.
And speaking of diversification, maybe you could give your thoughts on alternatives.
Yeah, so we have a guide to alternatives. I hope many of your clients have seen this, also run by my colleague Aaron Mulvihill. I remember I was on a webcast with him yesterday, and he was saying that alternatives are kind of like a box of chocolates. So you never know, like Forrest Gump, you never know what you're going to get. But what the Guide to Alternatives tries to be is sort of the index. You know that little card you get in a box of chocolates, which tells you exactly what's inside each of them. It's really important to know that. And there are lots of varieties of alternatives. So what we show here is, over in the far right, we show the Planet 60/40. So that's a 60/40 stock bond portfolio. And as you go up and down, you look at the yield on those. The return on these portfolios. So if you want more return, things like private equity and venture capital have given you better returns. So has infrastructure over the years. If you look at the size of the bubble, that's where you see income. So that if you just want income from a portfolio, things like private credit or direct lending, things like real estate can help you with that. Or if you're just looking to diversify, there are things that diversify you a bit, which are less correlated with 60/40 portfolio. And then there are things like real estate, transportation, infrastructure, which really diversify you a lot. So it adds stability as well as adding income and total return to a portfolio. So I think investors should really think about having alternatives in a portfolio.
Great. Well, thank you so much. I think that brings us to the end of our questions, but we did have a couple great audience questions come through. So I hope
Sure.
I can steal about 5 minutes more of
Absolutely.
your time.
Absolutely.
Um, do you think the economy is healthy enough to support new highs this year?
I think we could see new highs this year. That's always possible. I don't necessarily think the economy is healthy enough for it. I think there's, um, I think that the markets are pretty highly valued. I mean, if you think about it, we went into this year, we're basically back to where we were at the start of the year. But a lot has happened that we should be concerned about. We've got geopolitical tensions, of course, but we've also got tariff policies and immigration policies, which, as an economist, they're going to slow the economy down. They're going to give you more uncertainty about inflation and slow the economy down. You've also got the tax bill will do some stimulating the economy in the short run, but that won't last forever. So yes, we could see new highs, but I don't really think that's I mean, I wouldn't try and trade this market. I think as a long-term investor, I'd want to be appropriately diversified. I think that there's still enough uncertainty out there that you want to be a little bit defensive after two super years. And, I'd want to, some markets are going to hit new highs. I'd probably want to have more money in add to my international holdings rather than just add to the S&P 500 or the mega caps within the S&P 500.
Great. And I think lastly, what parting words of advice would you have for your audience? And then specifically, what advice would you give to future young investors?
Well, the first piece of advice is, there's a very old saying, it came from a Greek philosopher, that a man never steps in the same river twice. And it's because it's not the same river, but he's also not the same man. I think we spend so much time looking at the markets, the economy, that we kind of forget to look at our own portfolios. And this is particularly true for older investors. You may have had a certain amount of money and a certain balanced portfolio at the start of 2019. Maybe it was a 60-40 portfolio. But if you didn't rebalance and all the coupons went back to the bonds and all the dividends went back to the stocks, guess what? You don't have a 60-40 portfolio anymore. You've got a 73-27 portfolio. You're richer, but you're also taking more risk. And is that appropriate? So I think you have to really think about, is this portfolio appropriate for where I am in life? That's the first thing. And for younger investors, I would say just, you know, actually don't sweat it. I mean, just invest broadly, bet on the forest, not on the trees. For the vast majority of people who are young investors, the truth is that's not the first thing they do. That's not their first love, and it's not how they make their money. It's not what they're talented at. But if you make money being an engineer or a musician or an author or any number of myriad of things, just invest broadly in an appropriate portfolio, a diversified portfolio for life. Get a book on investing, learn something about it. Don't just outsource it. You shouldn't outsource your health entirely. You should know something about it, and you shouldn't outsource your financial health. Know something about it. Understand what a stock is, what a bond is, why they put together portfolios the way they do. Understand what your genuine risk tolerance is. Understand how long this money is going to be invested for. In the long run, stocks tend to outperform. Figure out where you want to be in it. But take ownership, but don't try and hit home runs here. Just make your money in an appropriate way and allow markets to amplify those returns over time because you've invested in them in an appropriate way that can build your wealth outside of what you do as a passion.
Well said, Dr. Kelly. Thank you so much for spending time with us today and sharing your much sought after viewpoint. We look forward to reading more of your notes on the market. For folks that are interested, those are released, I believe, every Monday morning on both LinkedIn and J.P. Morgan Asset Management's website. So please keep an eye out for those future notes. So without further ado, I'm going to bring our headliner in today for the conversation, diving into the first of many stock ideas today. Steve Cress, for those of you who don't know, is the VP of Quantitative Strategy at Seeking Alpha and the architect behind the platform's widely revered quant rating system, Alpha Pick service, and newly launched Pro Quant portfolio, all of which we're going to detail further in our second session today. So please stick around. So Steve, I think David has really set the table with the macro lens on the current market environment. And I think your expertise can allow us to take that macro view and translate it into some actionable customized stock picks using our quant system. I think to summarize, Steve, based on Dr. Kelly's insights, he's been favoring more defensive stocks, international equities, and alternatives. So I'm wondering if you could kick things off with some quant recommendations that dovetail Dr. Kelly's view today.
Absolutely. And Dr. Kelly, thank you so much for your time today. Your words really speak to us at Seeking Alpha, and particularly our quant system seems to be really following in terms of what comes at the top of our quant system in regards to what you're mentioning with sectors and stock specific. So I think what I'd like to dive into are a couple of the quant recommendations based on Dr. Kelly's view. So why don't we start with our top recommendation? And okay, so I'm going to try to pull this up myself. And
if you're not able to get it there, Steve, I can tip you off. Our first selection is Airbus today, aerospace and defense.
Right. So perfect defensive stock, it truly in its nature, aerospace and defense. Also an international stock as well. So I think this fits very well within what Dr. Kelly is providing in terms of his guidance, diversification, international stocks, defensive in nature. And I'm going to ask you to hit on the bullet points that we have there because I can't seem to get the presentation up on my side. So.
No problem. Just to flesh out Airbus a little bit more, it's got a massive market cap of 147 billion. It's currently a quant rated strong buy, and it's domiciled in the Netherlands. The sector, it's an industrial stock, and it's ranked 13th out of 614. and number 2 in its industry of aerospace and defense. So for those of you that are less familiar, it's a primary competitor of Boeing. It maintained the massive backlog of over 8,600 aircrafts. And if we're going to dig into some of the quant metrics that make this, a sound recommendation, it's got a really solid growth grade. It's got an A growth grade. And some of the highlight stats there are a 90% forward EPS growth versus the sector's 7.6%. It also boasts really solid profitability. It's got a 22% ROE, which is 77% above the sector. And then another standout profitability stat there is its 9.8 billion in cash from operations.
But thanks so much for highlighting that. And I will say with Airbus, it is based in the Netherlands, but it is truly a very European company, where manufacturing occurs across Europe. So you're really getting tremendous diversification in its labor force as well. One of the things I'll highlight, and now I am now able to sort of take a look at the first slide that's coming up. If you look to the far right, you'll see the factor grades. And I think what I find very interesting here is on growth. If you look at the growth grade for 6 months ago, it was a D minus. The current growth grade is A. And something I'd like to highlight with the factor grades is that these are all sector relative. So as you're looking at valuation, growth, or profitability, and you see those grades, it actually provides you with an instant characterization of how that metric compares to the rest of the sector. So it's not in only absolute terms, it's really in terms of how it compares to the sector. And we could see in itself, it's an A. So compared to the sector, it's great. But compared to where its metric was 6 months ago at a D minus, the growth has really come along tremendously. And as I've already highlighted, 22% ROE is far, far above the sector. And they have a huge amount of cash in operations at 9.8 billion. So that is our first choice based on Dr. Kelly's guidance. Emma, can you bring us to our second choice?
Sure. Our second choice today is
Heineken.
Heineken.
And I think a lot of people, based on this year, could really feel it as if they need a drink. A Heineken beer could, really hit the spot here. So we have a quant strong buy on Heineken. This is a tremendous company as well. Its market cap is close to $49 billion. And within the consumer sector stable, it ranks 11 out of 178 stocks. It is a brewer where it ranks number 2 out of 7. And I do want to mention these stocks that we are referring to, both international, both out of the Netherlands, but they do have ADRs. So they do trade in the United States. The ticker symbol for a Heineken's ADR is HEINY. Tremendous margins, 19% EBITDA margin, which is a 44% premium to the sector. This company also has just a huge amount of cash at 5.7 billion, which is a 533% premium to the sector. And the stock is dirt cheap at 8.3 times on its forward PE basis. Not only a 57% discount to the sector, but if you look at the S&P 500, which is well over 20 times, it is at a steep discount to the S&P 500. So the stock just recently became a strong buy. For the most part over the last year, it was a hold, and it was even in sell territory briefly. And if you look at our quant rating chart, you can actually see the sell did come in at a good point because the stock did fall. And then it was a hold for a long time and just recently becoming a strong buy. And I think a lot of that has to do with where you see the growth grade. A number of analysts have moved their EPS revisions up for the stock. So on the factor grades, you'll see on the far right side, the last factor that we look at as revisions, that is actually the quantity of analysts that move their estimates up or down compared to the sector. And a lot of analysts have been moving their earnings estimates up for Heineken. So very well positioned. And Emma, let's go to our third stock based on Dr. Kelly's views.
Great. And I just want to reiterate to viewers today that these stocks are specifically related to Dr. Kelly's discussion. The main event, which will happen a bit later, our top 10 stocks for the second half of 2025, those are separate. So yeah, there's just a distinction between the two. And lastly, our value pick is Orange, ticker ORANY.
Yes, another ADR strong buy. Market cap uh, still very large, not quite as large as the other companies, coming in at close to $40 billion. But in the communication service sector, it actually ranks number one out of 231 stocks. And for those who are not familiar with Orange, it is an integrated telecommunications service. They provide a tremendous service in the UK as well for mobile phones, but they have growth all over the world. Strong focus for them, and our high growth markets right now are in Africa, which is helping to drive their growth. Their earnings per share, their long term growth rate is 19%. That's the EPS for long term growth rate, which is the 3 to 5 year CAGR. That's a very important metric in the quant world. Not all metrics are created equally. Some are more predictive, and the long-term growth metric that we look at is a highly predictive factor. So coming in at 19%, it really helps it out. But of course, the margins look great on this company too, with a 32% EBITDA margin, putting it at a 63% premium to the sector. And if we combine both the valuation and the growth rate together, we have a forward peg, which is 0.62 times, which is extremely cheap. And that's about a 55% discount to the sector. The stock is up about 50% over the last year, but I will say do not make that let you hesitate, I should say, from investing in the stock. If you look at the far right where the factor grades are, you can see 6 months ago the valuation grade was an A, and currently the valuation grade is an A. So there's really been no change in the valuation framework despite the company's growth. And you can actually see on that factor card, 6 months ago, the growth grade was a D, and currently it's a C. So it's made a full grade move up, going from D to C. So that speaks very well of the future growth for the company. Analysts like this company as well. You can see the revisions grade is an A now versus 6 months ago, where it was a D plus. So analysts increasingly are taking their numbers up and not down for Orange. So again, as Emma mentioned, these are our three picks based on Dr. Kelly's views of international diversification and somewhat defensive stocks, being in aerospace and defense and telecommunication services. Um, these are selected using our quant system. The great thing about the quant system is you could take a look at any sector and identify what the top stocks are in the sector. And you could take a view of an individual such as Dr. Kelly or a different strategist who might have a completely different view and still be able to identify top companies in a sector. So should somebody, instead of being very defensive and not looking for diversification, if they were very focused on growth and US and technology, you could easily find those companies within our quant system as well. And I think that about summarizes it for Dr. Kelly's presentation and for the stocks that we would select on the back of that.
Well
Evan,
said,
back to you.
Steve. Thanks. Yeah, and just to reiterate, folks, this is just a teaser on our quant system. If you want a more in-depth exploration of this, as well as some of our stock recommendation tools like Alpha Picks and Pro Quant Portfolio, we'll be doing a more in-depth discussion in the second session today. Steve, we did have a few questions come through, so I wanted to take the opportunity to just ask for the uninitiated, how often are our factor grades refreshed?
Every single day. So that's a wonderful thing about the quant system. And it makes it, even though the quant system is based on fundamental analysis, which is commonly used by analysts from J.P. Morgan or Merrill Lynch or Morgan Stanley, we do look at fundamental factors. But the big difference is we refresh our data every single day and our directional recommendation. So what that means is our system goes through income statements, cash flow statements, balance sheets, and hundreds of financial metrics. It refreshes it. We create scores. So as I pointed out with those factor grades, they're sector relative. So we want to be able to identify the strongest companies in a sector and the weakest companies in a sector. And through our powerful computer processing, it enables us to do it every single day. So we can actually provide a directional recommendation, being either a strong buy, a hold, or a sell based on our data-driven process.
Great. And then this is a great question, I think, about implementation. Would you recommend buying your stock pick straight away, or would you advise folks to wait?
I would say if there is a strong buy quant rating or a buy quant rating, you can buy that stock. In many instances, a company will have a strong buy recommendation for a matter of weeks, if not months. We look at that valuation and growth framework every single day. So anytime that you see that strong buy or buy recommendation, you can buy the stock at that point in time.
Great. Well, I think at this time we're going to enter into a brief break so everyone can, grab a cup of coffee, take a walk, and we will see you here promptly at 1:05 p.m. Eastern Time for our second session of the day.